Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the line with us today is Cecil Musgrave, publisher of InvestorsGuru.com. Cecil, we connected over 2 years ago, and I don't know why we haven't talked yet on the show, but it's very pertinent timing to get you on as your site is 20 years old this year. Cecil, welcome to the show.
Thanks, Colin. Thanks for having me.
I want to start out by talking about how you started the site and the relevance of the site today.
Started the site around 20 years ago. At that time, I was leaving the brokerage industry. My background's kind of varied. I've been in number of small businesses. I have a computer science background, and I have a brokerage industry background. So at that time, I had a lot of clients who were trading penny stocks. They had no guidance whatsoever. I was interested in them myself, in the mining space, and so I started the website. It was at that time there really were no financial websites, and my site started as a gray page on a university server. And so I wanted to just form a club where investors would, I would write about stocks and give my ideas, and I'm looking for feedback from other people, and it just mushroomed overnight. So, and then, we got companies calling saying, hey, we like what you're saying, why don't you write about us? And so, a business developed where we could sell banner ads and do some marketing that way if we liked the companies. And so it grew over the years, and we developed, a large reader base, and that's expanded. Of course, you got the whole social network with the Facebook and the Twitter and the video and the mobile site. So it's and we have our syndicated blog, and so it's grown that way. And so the interest is always there. Mining cycles, come and go, and so my interest right now is mainly in the mining space, and and I've been waiting for this since 2011 for this sell-off, and I think we're finally there.
Well, you have tremendous insight into the mining sector, part of that being you have been around for 20, 25 years watching the sector. You've seen multiple cycles. And before we got on the call today, you were providing some great insight as to where we are right now in the cycle. You touched on the fact that, listen, it's been 4 years. I don't need to know if the bottom is here, but I need to know if it's probably close. And you seem to think that is the case. Can you talk about where we are in the cycle right now?
Yeah, I think that's exactly right, Colin. I mean, in my last article, I showed a chart where I'm looking back at what happened in the 70s, and that's when gold came from around $35 in around 1970 and ran to around $200 at the end of 1974, then had about a 57% or 50% pullback, actually about 47% to 103.50, I think it was. And then you saw gold go from around $103.50 to $200 over the next couple of years. And that's when a lot of people probably said, okay, great. They probably sighed in relief and said, now I'm at my break even and let's move on. That's just at the point where gold went parabolic. And from that $200 level at around 76, 77, that's where it took off to 850. Now that was inflation driven back then, and everybody discounts inflation today. I think there's more inflation in the economy now than what we actually see. It's just we're not seeing it in the same way. I mean, I call it shrinkflation because I don't know if you've noticed everything you buy these days, the price is staying the same, but the portions are going down. And I can give lots of examples of that, from toilet paper to the number of sheets on a toilet paper roll to, vegetables, which they can't really mess with the size, but they can give you, a few pounds less at a lower price, to a loaf of bread that's gone from 675 grams to 450 grams, while the price has gone from $1 a loaf to $3 a loaf. So inflation's there. It's just hidden, and you're not seeing it in the GDP because a bottle is a bottle and a loaf is a loaf. They're smaller now, so you're buying them more often, which is still inflation. But we're not seeing 1970 style inflation. And everybody has pretty well ruled that out. And I'm not even saying that that's coming back. We don't need to see that come back, but it is a possibility. And, everybody's focusing on, central bank actions and Asia. And, these are, I look at those as short-term trends within a long-term secular bull market. And those things affect prices in the short term, but what is really driving the price of gold in the long term is monetary. And if you look at the M2 as it's increased, especially since 2008, all those trillions that were issued to the banks as debt is still out there. It just hasn't hit Main Street yet. The banks, they're basically borrowing that money at 0% and they're speculating in the market. And now we see the bubbles, except the risks are much greater today. I mean, in the 1929 stock market crash, we had 10 to 1 levered margin, which at least contributed to the extent of its fall. And in 87, during that crash, we had program trading tied to indexes and portfolio insurance that exacerbated that fall in 87. And in 2008, we saw banks like Lehman levered at 40 to 1 or 100 to 1, and that's contributed to that collapse. Well, it hasn't improved. I mean, there have been some improvements, and the economy has gotten somewhat better, in my opinion. But the leverage is still there. I mean, the complex derivatives and hedge trades, they're in the quadrillions now. I think the last number I saw was around a quadrillion and a half dollars. So the risk there is the counterparty risk. So, if that unwinds, where are you going to go? And in any event, if we do have, I shouldn't say if, when we do have a market correction, where are the big money flows going to go? And typically they'll want to go back to resources. Resources generally lead coming out of a recession. So and things seem to happen a lot faster now than they used to. So there's a convergence of events that make gold look good. But you kind of got to put those off to the side and say, well, what do we have right now? Let's look at this as a business. And this is the first time in 20 years that you can look at mining as a real business where you've got real assets and real cash flows and real production, and they're undervalued. Like, you've got gold mining stocks that are trading at 10% of what they were in 2011. Gold price is half of what it was back then, but the gold shares are 10% of what they were back there. And there are some companies there that have no debt or very little debt. They have positive cash flow. They're producing at they've got a profitable margin even with today's gold prices, and some of them have even, done better than that because they've hedged, and some of these stocks are trading at 20, 30 cents, and some of these stocks were $4, $5, $10. There's one that I'm looking at that was $15 a few years ago, and the growth potential, like, these are companies with many millions of ounces of low-cost ounces, so. I'm stepping back in. I don't need to know that I've hit the absolute bottom, but I think we're close enough, because if gold goes much lower, below $1,000, mines are going to start closing up. We've already seen some of that. We've seen a consolidation. So there may still be a capitulation point, and I'd like to see it. Get it over with. Raise interest rates in December, and let's have that sell off. Let's have a major go bankrupt. Sell it down. Great. Then I can buy even cheaper, and I think we're positioned. So I don't know if it's going to be next year or the year after that, but I think we're close enough that we can start taking a close look and stepping in.
The last time I had Doug Casey on the show, he pointed out that most people do not react to inflation until the depreciation of the currency reaches something like 50%. I don't know the accuracy of that statement, but it's a pretty astounding number. And by that time, gold is already up several 100%. But who would have thought that we would get these kind of bargains in gold stocks prior to what could potentially be one of the more epic runs in the whole last century? In fact, we've gotten to the point where, going to the theme of this interview, you've touched on, this is Warren Buffett style investing now available in the mining sector. That's not supposed to happen because these mining companies have resource in the ground. These resources are being discounted to zero or less than zero now. And I want to go through, you're publishing an article the same time as this interview is going to be published, and we're going to do kind of a 3, 2, 1 countdown here where you touch on your 3 very favorite picks in terms of these Warren Buffett style investments. Let's start with the first one, which is Timmins. What can you tell us about that, Cecil?
Timmins is an interesting company. I've been watching it for quite a while. I mean, this stock was, I think, $1.30 or $1.40 earlier this year. The stock was well over $3 a couple years ago. They're mining in Mexico, in Sonora, and they have one producing mine, a heap leach mine called San Francisco. It's fairly low grade, but they're their average production costs, I think, are around $800 an ounce, and they've been producing profitably this year, and maybe not so much with the gold price. So there's reasons why the stock should be down. But this, why should this stock be trading at 10% of where it was? And the reason I say that is, I think they paid somewhere around $125 million during the New Strike Capital merger in May, where they acquired two more projects, Ana Paula and Cabala Blanco, I think the other one was called. I'm just looking through my notes here, and Timmins has, I don't know, have their exact resources here, but they have millions of ounces to grow with, and Ana Paula has higher grades. And one thing I was watching, one of the reasons I didn't step into this stock earlier is I noticed that the GDXJ, the Junior Gold Miners ETF, had 18 million shares. And what's interesting about that is, I mean, I've looked at buying that, and one thing that bothered me is they, under their rules, I think if a company has under a 75 million market cap, they at least have to consider selling at that point. And I think short sellers take advantage of that. And if they see a stock that they think they can knock it down to that level, it just seems to happen. And sure enough, Timmins was going down to that level. So I waited. And they also punish miners that have been doing acquisitions. You're supposed to be buying when assets are low, and Timmins has been doing that. And their balance sheet has been healthy. They have a little bit of debt, mainly short-term debt, which I think they've cleaned up, and not very much long-term debt. So I think there's value there. So that I think there's an overhang where people were saying, well, how are they going to raise the money to put Ana Paula into production? A lot of that became a little more clear every third Friday quarterly. The GDX rebalances, and I think it was around September 18th that Friday. You saw the volume in Timmins go from around 1 million shares to 24 million shares, which I believe was probably the GDXJ selling. And if you look on their website, they don't show the holding anymore. So I can only presume they don't hold it anymore. After that close on that day, they announced a deal where they bought a process plant from Goldcorp for, I think, around 8 million Canadian. That will save them somewhere between 40 and 60 million US. At the same time, Goldcorp, they made a Canadian $6 million investment to hold around 10% of their shares, which is a nice endorsement to have Goldcorp there. So I think that they're positioning this company, and they're going to need to raise, I think, around another $100 million to get everything fully into production. But as a result, as this market turns, they're going to have two mines into production, hopefully, and they're targeting somewhere around 200,000 ounces. They're doing around 125,000 ounces now, I think, and eventually to go over 300,000 ounces. So you've got a mid-tier producer trading at around, it's at its low rate, 26 cents. And I would wait. I'm waiting until next week until they put out a news release on October 6th. They had a management change, and they're going to do a revised mine plan. So it's time to update their cost, and they did indicate that there's going to be a substantial impairment chart. So you have to take that into consideration. There's some risk there. So I'm going to wait till that gets out of the way and see where the stock shakes out. And then going into December, into tax selling season, I think it's a nice play. I think they're positioned now to get that second mine into production. I think the value's there. The balance sheet's saying so. I don't think there's any financial troubles here that's not going to carry them through to the next cycle. So, that's one I'm willing to bet on, and I put it on my top 10, my top 30 stock list as one of my top 10 stocks.
I'm happy you brought up the GDXJ. There's a theory my very good friend David Skarica told me a couple months ago, and you just confirmed it, that with the advent of these ETFs and so much money being in the GDXJ, when the GDXJ gets sold down and you're in a depressed market and you have these illiquid stocks, you get an outsized selling effect that further depresses the prices. And for somebody starting to buy now or in December at tax loss selling season, you're probably getting a lot cheaper price on these stocks than you would if the GDXJ never existed. Let's go on to number 2, which is Banro Corporation.
Just one thing, absolutely, and there's going to be another reconstitution in December. So I agree with what you just said, and I'm watching the holdings of the GDXJ, because there's other stocks there that, I'm wondering if they're going to get back down below that 75 million market cap, that have value that they may also dump. And isn't it interesting that this news came out after the close on the exact day that GDX selling occurred last quarter. So the companies know that that horde of shares are out there, and that they might be, they might come onto the market. So let's let it go, and then we'll address it. Let's not put out good news into all that stock that's coming into the market, and that only makes sense. Banro. Banro is one of the most exciting plays I've ever seen. Now they're in West Africa. They're actually in the Democratic Republic of Congo, which is even risky for Africa. So you have to take that into account. And a lot of people, that absolutely wouldn't be appropriate just for that reason alone. But everybody talks about safe jurisdictions, and that is important. Yes, I would prefer that they were in North America. But you got to go where the gold is, and there's problems with every area. I mean, in Canada and the U.S., you have problems with indigenous nations. There's mines that are located underneath of towns that you have to move around. There's environmental concerns, and that's true everywhere, whether you're in South America, and there's political and currency risks. But if Europeans look at Africa as a much better place to invest than we do, we might be more favorable towards South America. It's just proximity, I guess. But Banro has basically a whole gold belt, that Twangisa-Nimoya belt, which is like 210 kilometers long. And they have one mine. Their main mine, Twangisa, at one end came into production, I think, in 2012, and their second mine is ramping up right now. They're producing about 12,000 ounces a quarter, and when it comes to full production, I think they're saying 9,000 to 10,000 ounces per month will come out of that mine, and it's at the other end, and in between it are two more mines. And if you look at all the gold resources in all categories, all confidence levels from proven and probable to measured and indicated to inferred, I think I calculated it's over 15, close to 16 million ounces, and they're low cost ounces, and they can bring those costs even lower if they in the future they have planned to put in a hydroelectric dam that will bring they say that it can bring their costs down around $100 an ounce. So lots of growth there. I think they're targeted to produce somewhere between 175 to 195,000 ounces this year. And as Nimoya ramps up within a year, just my back of the envelope numbers say they could be doing 250,000 ounces maybe this time next year, or at least by the year after that. They're showing record quarterly revenue and EBITDA. So they're flowing. And it's going to Nimoya, which I think their Q2 says that they have invested $396 million on that mine now. So that mine is coming to full production. I don't know what other commitments there are to finish that off, and they have done some streaming arrangements which you have to do. And I think it's positive to do that, because I definitely don't want to. This stock is around 20 cents. As a shareholder, you don't want to see them, massively diluting the stock at that level. So I think the growth trajectory is good. I think their costs are right. If you can live with the Democratic Republic of Congo, they have had hiccups in the past. I think they even lost this mine. I think Casey was following this years ago, and they got it back. And I'm watching their social development. I mentioned in one of my articles that mining companies really can't develop any brand value because they're price takers. Gold is gold. But way, Banro kind of has brand value because they have that relationship over the last decade, and they've done, they built like 10 schools and basketball courts and hospitals and women's residences and 500 kilometers of highways. They've given a lot back. I think the DRC needs them as much as Banro needs the DRC. So anyway, that's the way I'm looking at the bet, and I'm. This stock was a $15 stock a couple years ago. Now it's 20 cents. And, I think there's, even after $50 million impairment this year, I think $450 million in equity on the balance sheet, with a market cap of 50. So that's like 1/9 of its book value is what the stock's trading at. So it's not your grandmother's stock, because there are risks. You could wake up tomorrow and there could be a coup and you might not own anything. But if you want a leveraged play where there's tangible value, and that's where I think the Warren Buffett philosophy comes in place. I think Banro and Timmins and the next stock I'm going to mention, I think that's where it's at.
And Banro also has a history of being very responsive to the market moves. It exaggerates the moves that the bigger gold stocks have. That can be said for most mid-tiers, but Banro in particular, and I guess some of that's due to the Africa risk. And I remember picking some up in 2008 at around 80 cents and thought, wow, this is a great pick. And it ran over $5, and now it's hit a 52-week low of 12 cents. It's just unbelievable. And that leads me into your final pick, which thank you for bringing it to me. I've already added it to my portfolio, Perseus Mining. This one's just unbelievable to me. Go ahead and tell us about Perseus.
I should mention one more thing about Banro. There was a release where they mentioned that, I don't know, the NYSE MKT they may be under review because of the low share price. I read that as maybe they could be bumped off the Amex. If their share price isn't higher, and that could come. It may just go higher over the next year. They may give them an extension. They may roll back the stock. There's lots, or they could just say, look, hey, we trade on the Toronto Stock Exchange. Let's just keep trading there. I don't know how that can affect the stock in the short term, but it may be a concern to some U.S. investors. I just point that out can't point out all the risks. You need to do your due diligence and read the releases. But I'm digging, trying to find these stocks are cheap for a reason. So I'm trying to dig. And anyway, Perseus is right now it's my number one stock. Their last quarterly was just amazing. This company earned, I think from memory, 92 million Australian. They're earning something like 16.7 cents per share. And they have right now cash and bullion. That's about 3/4 of its share price. Now when I wrote this was around 33 cents, and I think the stock's around 35, and it had gone up to 40. So, just with the no move in the Fed this week, so the gold's pulled back. So that's good. But they have their main mine is an open pit mine in Ghana, the Edikan, and I think it has 8 pits. They're all large resources, and they can adjust the pit values. There's a sequence that they were going to mine them, and I think they've adapted that sequence so that they're going to mine the higher grade pits first. But they're producing record profits right now. Like I said, I mean, this stock is trading at cash. And I think their resources are over 12 million when you factor in what's been proven at Edikan, and also their Sissingué, if I'm pronouncing it right, in the Ivory Coast. And that mine, they said in July that they were going to start the construction in the September quarter, so they should have already started it. And I think they've gone through the permitting issues. There's probably some final permits. So they're saying that within 14 months, they should be able to do their first gold pour there. They have over $100 million cash, plus another, I think, 30 million in bullion. Check those figures. It's just amazing that this company has so much cash as a percentage of its share price. Their PE. When do you ever talk about a junior miner at this price that has a PE? The PE on the stock is 2. So I'm again, they're in West Africa, but this is a company that will be producing how many? Couple 100,000 ounces, I think, this year. So I think they're on track to do maybe 300,000 ounces over the next couple years. I've never seen a company zero debt. So if you look at the shareholders' equity, if you look at the cash, if you look at the cost of the plant and subtract that from the market cap, you've got cash that is equal to or exceeds what the whole market cap of the company is when you factor in those costs. So I don't know if I'm phrasing that right, but basically I'm looking at it and saying they're not putting any value on any of the gold. So to me, that's worth holding. And Perseus I think was over $4 a share a few years ago, and I don't see why in a better market we can't wait that out. They're going to use some of that cash to develop Sissinghee and do some further exploration. But they've got a lot of gold here that they can be mining these mines for decades. So they're not safe plays. They are in West Africa. Perseus got slammed with a lot of the other West African plays last year on the Ebola situation. So those things happen, and that's presented an opportunity where I think these stocks are cheap enough that for high risk, dollars, that's the way I'm looking at it. Is the leverage is there, and it's not leverage to will they discover something? It's only leverage to the price of gold going up, and I think these ones could go up more. So and the value's there in the meantime, and even technically looking at their charts. A lot of these stocks have flatlined, whereas a lot of the mid-tiers and even the majors that I'm looking at that I think have value, they are cheap. Doesn't mean they won't get cheaper, and they're on the wrong side of the mountain, as I call it, and still sliding down. Well, these ones flatlined a while ago, so I'm thinking, the timing's close.
That's right, and the key here is coming back to where we started the interview. Only 5% of investors buy within the bottom 20% of the market and sell within the top 20% of the bull market. But if you buy Banro at 20 cents or 15 cents and it ultimately goes to $15, you're going to be pretty happy either way. Like you said, we don't know if the bottom is in yet, but we know we're near. Any closing thoughts here before we end the interview, Cecil?
Well, I think you got to look for value where everybody else is not looking for value. And the big there are some big money flows. I think the Druckenmillers and some of the hedge fund guys are starting. They're in and out of gold. Paulson, I don't know what his gold position still is, but these guys know, and they move fairly quickly when they see a change in the market trends. And sometimes they need a parking spot. So gold used to be that parking spot, and I think that everybody is so sick of the way the miners have performed. I mean, like I said, gold is down half, while a lot of these miners are at 10%, that they've totally given up on them. And in the past, when gold did well, the gold miners outperformed. I think that's going to happen again. I think the companies have finally learned their lesson. They over-leveraged their balance sheets for acquisitions, and I think that deleveraging process has a while yet to go. But there's some companies that were thrown out with the bathwater, and they did a really good job. And I think those ones are going to be surprised, and they're going to respond first. And value is value, and so you can find it. You don't, I started by looking at the majors, and when I got into the balance sheets, I'm not an accountant or anything, but as an investor, been around for a while, I'm looking at these balance sheets, and I'm saying, that's not. I don't think that's the place to be. There's too much leverage there, leverage to debt. So then I started going down, and I'm finding, oh my goodness, there's companies here that are trading for pennies, that are producing profitably with good margins, with big world-class resources. I don't have to speculate on companies that are drilling, that may or may not find something, that are in the permitting process that can take years, that are in the financing process, or the construction phase. These guys are already producing. They're just adding to what they already have, and it's a nice place to wait until this cycle turns.
All right, Cecil, well, really just a phenomenal interview there. Great information. I think that'll be reflected in the feedback from our audience. So thank you for coming on. We were going to talk about uranium, but I'm going to put a bookmark in the interview here, and that leaves us a good entry point for our next interview. We can talk about the much hated sector of uranium. Cecil, thanks so much for coming on the show.
Awesome, Colin. Thanks for having me.
think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?